Now, a year ago, March 2024, we got the breakout here of a 13-year cup and handle pattern. So that's extremely significant. Then on top of it, a year later, we finally get the breakout of the 60/40. And so this simply tells us that more conventional capital that's in conventional investments like bonds, but mostly stocks in the current case, that is going to move out of stocks and bonds. I mean, it's already been moving out of bonds, but more so stocks now, and go into gold.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a very exciting discussion lined up today that I'm very eager for. Today, we're fortunate to have with us Jordan Roy-Byrne, editor and publisher of thedailygold.com and the Daily Gold Premium, which emphasizes market timing and stock selection for precious metals investors. Jordan is a chartered market technician and a master of financial technical analysis. He's also the author of the most recently released book, Gold and Silver: The Greatest Bull Market Has Begun. There's so much to talk about. Jordan, welcome to Metals and Miners, and thank you so much for joining us today.
Gary, thank you so much for having, and a double thank you for that very nice introduction.
Well deserved. All right, Jordan, gold is experiencing back-to-back days of 100 plus gains intraday. What is the price action specifically telling you about what's happening with gold right now?
Well, one thing I would say, and I mean, it's really hard. I kind of like to step back and look at a longer time frame. So it's really difficult to like pinpoint a major message from a couple days. But it is really surprising how gold basically around this turmoil has been able to rally back basically to the high from a couple weeks ago. So that to me, I guess I would say, that shows more strength than I think most would expect. I mean, because if you listen to other interviews, kind of more on the national programs, or people who generally comment on most markets but not gold specifically, I mean, just here and there, I would hear them, and they were expecting, okay, well, gold will sell off. Gold will sell off. It'll be the first to recover. That kind of thing. So I think most people were expecting more weakness in gold, myself included. But we'll see if because gold could, I mean, it could consolidate here around the high, and I've been thinking maybe it'll do a bullish consolidation over the next couple months. But I could be wrong about that, and so it's. Yeah, back-to-back $100 days. That's really interesting because typically you might see one day where it's up $100. It's a big recovery. The shorts are covering, so you get that kind of a move. But to see it 2 days in a row, I mean, there is real strength in this market, like real buying power.
So strength in the gold market is the takeaway, and that's a good takeaway for those who are paying attention to gold. And for those who are not paying attention to gold, they need to see that strength in the midst of this volatility and turmoil, and probably start to significantly pay attention to it. Jordan, we were talking about a bunch of charts that you want to share with us, educate us on the technical analysis side. You have a chart that shows gold against the stock market and gold against the 60/40 portfolio. You have some insights to share with us. So if you could pull those up and just go ahead and dive in for us.
Sure. Okay, got it here in a second. Okay, there we go. And yeah. So what we're looking at here, this is a chart that goes back 100 years. So this is gold here at the top. This is gold against the 60/40 portfolio, gold against the stock market here, or the S&P 500. And so gold against the 60/40, this is kind of like my baby. This is like my holy grail indicator. So we're looking at gold against, this is the classic investment portfolio. You put 60% of your retirement or your money in stocks, 40% in bonds. I mean, it's, for some people, it's a 70/30 or 80/20 or 50/50. But 60/40 is generally the baseline. And, gold is an investment from a bird's eye view that really performs best when it's outperforming conventional investments. maybe for a year or two, you can kind of see gold go up with stocks or gold go up with bonds. But for the most part, you step back when gold is in a real bull market, it should be strongly outperforming the 60/40. And that's what we see here. And we see, 1930s, of course, the gold price was fixed. Gold stocks made a huge move. Same thing happened in the mid 60s before we went off the gold standard in 1971. But you can see here, what has preceded these huge moves in gold. And so we're seeing the same thing again. And this is really interesting because this is a 10-year base. Now, this was powered in the last month by gold breaking out against the stock market because this has been stronger than this because bonds have been so weak in the last few years. But stocks were still, gold was not outperforming stocks, or at least not enough until basically the last month or two. So what we've seen in March, really the beginning of March, this is a monthly chart, by the way, so this is all monthly data. But what we saw in March was gold exploding here against the stock market out of a 4-year base. And as a result of that, you got a big move higher in gold against the 60/40. Because remember, this is basically 60% of this chart. But I can't tell you how bullish this is, Gary. I mean, this is so super bullish, breaking out of a 10-year base. Now, a year ago, March 2024, we got the breakout here of a 13-year cup and handle pattern. So that's extremely significant. Then on top of it, a year later, we finally get the breakout of the 60/40. And so this simply tells us that more conventional capital that's in conventional investments like bonds, but mostly stocks in the current case, that is going to move out of stocks and bonds. I mean, it's already been moving out of bonds, but more so stocks now, and go into gold. And that is what powered, specifically this bull market here and this move. We can see, it's highlighted by these charts. And so the technical analysis I do, I mean, this is a form of intermarket analysis, which is really powerful because, again, if conventional investments are doing well, you don't have any need for gold. People are not going to put their money in it. It's not until conventional investments run into problems and they don't perform as well and they're breaking down against gold, that is when gold does its best. And so this is so powerful because gold was going up in the last few years. I mean, even here, but you didn't have this breakout against conventional investments. So this is why what has happened in the last 5 or 6 weeks is so massive because it signals that, again, conventional capital capital is moving out of conventional assets and investments into gold. So again, this is, and you look at this has only happened 4 times in the last 100 years. So this is so powerful, so important.
Today's video is sponsored by Mnt&x. What if your gold could grow over time so that you're not just preserving, but growing your wealth in an asset that can't get inflated away by more money printing? Mnt&x lets you do just that. You could earn 3% on gold, paid in gold, in their secure gold leasing program. And if you're an accredited investor, you can earn even higher yields in their bond offerings. Previous bond offerings have paid 6%, 12%, and even high as 19%, all in ounces of physical gold and silver. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. The question is this: why earn in dollars when you could earn in gold? Join thousands of investors earning interest in physical gold and silver every single month with Mnt&x. So visit monetary-metals.com/Bohm to learn more. Okay, so there's couple of observations and you've kind of, let's leave that up there.
Okay.
Yeah. We've got a few more charts, so we'll just keep you with the charts here for now. There's a few observations I had there. One of them you kept repeating. The first one is that the consolidation periods in the 70s, prior to the 70s, if you want to put that back up so everybody could see. So the consolidation period prior to the 70s, late 60s that you pointed to, in the gold versus 60/40 portfolio. And then the consolidation period from about 98 to 2002 that preceded that bull run. Both of those consolidation periods are significantly shorter and more compressed in terms of time versus this 10-year consolidation in the gold versus 60/40 portfolio that we're breaking out of, correct?
Correct.
And what are the implications of this longer consolidation period in terms of expectations for a move?
Well, when you break out of a really long base, a pattern that's been in place for 10 years, I mean, the implications, and I talk about this in my book, the implications are massive. Like you're setting up for you're not just setting up for a move that's going to last a few years. Like this sets the stage for a move that's going to last, I mean, I think 10 years from this point forward. So this move in gold is going to last into the mid 30s. I know some people are saying, oh, well, there's, gold's been going up since here or right here. These moves only last 10 years. So maybe, we're going to have another year or two or it's it. But that misses the point that this is the real starting point of the bull market as compared to here and here. And that this breakout tells you, considering what happened here and here, and the fact that you're breaking out of a 10-year base, that tells you that you're having a move that's starting that's going to last, many years, not just a couple years. And it's the same thing with this 13-year pattern here. You're breaking out of a 13-year base. I mean, that's extremely significant. You're not just going to move up like this and then top. This is something that's going to last well into the 2030s.
Okay, so from a psychological standpoint, you have all these people who are working and they're on autopilot. They're, a percentage of their paychecks are getting put into their 401ks or whatever their retirement program is. And most of them have a split 60/40, 70/30, 50/50, just like you've outlined and laid out already. And there's really no reason to change it until something else is beating that portfolio. Is that what you're saying? When that
Yes.
portfolio is no longer operating at optimum capabilities, it's time to make the change. Now, they'll give it some time. They'll give it a year, maybe two. But at some point, are you saying psychologically they're going to get to a breaking point? Hey, this 60/40, this 70/30, this 50/50 portfolio is no longer working. They go speak to their financial advisor. I need to make a change here.
Yes, exactly. And, when we see these breakouts, it doesn't mean everyone, it's a good point that you made. It doesn't mean everyone's going to rush in immediately. This is just telling us that, there's a little bit more money is now moving away from stocks and bonds and into gold. And of course, it takes a long time for that. Again, people don't all come in immediately to that, they don't move away immediately from one asset to the other. I mean, it takes years and years. And I mean, it's the same. It's also the same conversely.
Well, that's why you said it'll last at least 10 years. I mean, that makes sense.
Yes. Yes. And it's also the same here. Like if you look at here and even you look at here after, this move, obviously some people started, moving away from gold and they were moving back into stocks. And, that took a while, although this hasn't been, it was really only severe for 4 or 5 years. And then of course we went sideways, but yes, yeah, your point is an important one. It takes many years for people to catch on and for everybody to pile in to gold. It doesn't just happen immediately. It takes many years.
Okay, the other question I have for you is looking at the angle from 72, we'll call it 1970 on, we're still on the gold versus 60/40 portfolio. From 1972, the bottom there, or 71, the bottom. Yes, it was jagged, and yes, it came down in that recession of 75 to 77, but then went back up. If you drew a line from, say, 71, 72 to 1980 to the peak, and then you look at the angle of the line from 2000 to 2011, that line is not as sharp as the line from 71-ish to 80. Does that angle inform your analysis as well? And if so, what are you expecting in terms of an angle for this particular bull run?
A very, very good question, and I have a very good answer for you. And by the way, you could, I mean, this gets cut off here, but you can notice that this is in the 30s is more similar to this. It's not as steep. Now, the reason we have a steep angle here and why this, there's actually two reasons, but the main reason is that during this period, let's step back for a second. What are the major asset classes? You basically have stocks, bonds, and commodities, or we can basically just say stocks, bonds, and gold. This period, stocks and bonds were in a secular bear market. This period, only stocks were in a secular bear. Same with this one. Only stocks were in a secular bear. So you could put your money in bonds here and still make money. So that's why this one is standing out here as the steepest and the biggest move, because the conventional asset classes, stocks and bonds, both of them were in a secular bear. And we are going to see the same thing. And so this is going to, it's going to be this type of a move
Okay, so
because
you're expecting a steeper
yes,
run, which means
because we're going to have stocks and bonds both in secular bear markets because bonds are already in a secular bear like they were here. So and next will be eventually stocks will fall into a secular bear. And actually there's three reasons. The other one, and this is important, this is gold is basically it broke out. I mean, this was artificial, and I know we'll get to this, but gold broke out and it was at an all-time high. So at the beginning, or in the relatively early part of this secular bear, gold had just broken out and it was at new all-time highs. Whereas here, look where gold started. Gold started, I mean, it was at 250. This was like 880. So gold was not at all-time highs. And the same thing for silver. Whereas, we don't have the silver chart here, but silver, this move in silver just went back to its 1980 peak of $50. So
but it
now
started at what, like $3 or $4 or $2 or $3?
yeah, like a dollar 50 or two, or depending on wherever you start it. But so they were at, gold and silver both in this bull early on, they broke to new all-time highs. When a market breaks a base and it's at new all-time highs, it can really, really fly. I mean, think about, the Dow Jones that had the 1966 to 1982 consolidation. 1982 was the beginning of that secular bull, and it began with it breaking to a new all-time high. So sometimes markets do that. And when you've broken to a new all-time high out of a long base like we did here, I mean, it sets the stage for a really long and powerful move. And so here we are where, again, based on this chart, we see that we're really just starting something. Gold is starting something based on this chart. And, a year ago, it broke out of this 13-year base. So gold is now going to be running at a new all-time high. Silver will get there eventually, probably in the next few years. So silver breaks above 50. That's the other factor. I mean, the main one is the fact that both stocks and bonds, like they were here, are going to be in a secular bear.
Okay,
So that means a lot more capital is going to come in. So
yeah, and here's an interesting thought as well. Back in the 70s, for the first half of the 70s, if I'm not mistaken, until 74 or so, gold ownership wasn't even allowed in the States. And then moving outward from there to other countries, the majority of the countries did not allow gold ownership either. Then you factor in the fact that the majority of people did not have retirement accounts. They were given retirement from their companies. So you didn't really, we're in a completely different ballgame. The 60/40 portfolio today has a tremendous amount more potential population globally that could invest in gold, and collectively a lot more reason to invest to protect the wealth they've already accumulated. So this gold versus 64 portfolio comparison, to me, is really interesting because of the dynamics have changed so dramatically from that 70s bull market. So if we're setting up for a similar dynamic with both stocks and bonds to be in a bear market and gold to dramatically outperform like it did in the 70s, it could be much more powerful than what happened in the 70s just because of the sheer amount of people globally that will want to protect against a decline in that 60/40.
Yes, yes. Yeah, the trend, it could be more violent. Um, but again, I mean, what you're saying is correct, but I mean, all that is the beauty about charts is all that is baked into these charts. So we can see that expressed by what's going on here and what's going on here.
Yeah.
And the fact the but what would align, I don't know if it's directly correlated to what you're saying, but again, breaking out of this 10-year base here and this 13-year base here, that's setting the stage for really, really powerful moves. And think about what you're saying because that aligns perfectly with the breakout of these two charts.
Yeah. All right. So do you want to move to the next chart, which is your 160-ish year historical gold chart? Jordan, it shows a significant cup and handle pattern. You've talked about this online, culminating in a breakout in early 2024. What I'm interested in, I think what everybody's interested in, is where might this breakout take gold prices versus the previous peaks that we've seen? And you had mentioned Depression era, Civil War era, in terms of technical significance, and why this particular breakout signal might be even more powerful than those. And the other component of that is you had mentioned in one of your posts about gold being reinserted into the global monetary system. I'm curious to hear your thoughts on that as well.
Okay, so yeah, I'll go through this quickly. So this, in my book, I talked about right here. If you look at commodity prices, it's very similar. Where you have the Civil War peak, commodity prices, you had a peak in 1920, and then I believe somewhere around here. But so 1972, commodity prices broke out, and I call that the greatest breakout of all time because that was from like a 110-year base. But really, gold is very similar um, because gold breaking out here in 72, 73, again, you can see here, this was breaking out of a 100-year base. I mean, it tested it multiple times. It wasn't just one thing. Well, when I'm talking about a breakout of a base, you like to see multiple tests, not just like one test here and then it breaks out here. Like that's not a 100-year base to me. This is where you have multiple tests. But and if I'm whenever I update my book, and I don't have plans to, but I need to put this in because this year was really the greatest breakout of all time. I know we're going to get to silver, which is setting up for number two, but so this was the greatest breakout of all time. But stepping back and looking at the progression of this chart, so you have this huge move here, then you had this bad secular bear here, then gold goes up here with a nice move,
You know
but
what? I'm not seeing that. Are you on that the chart of gold only, or are you still on the 60/40 portfolio chart?
I'm on the chart of gold. Can you see
Oh,
that?
no, I cannot.
Oh, okay. Let's see. Um,
Maybe unshare
maybe.
this. I don't know.
Okay, yeah. Let me. Okay, I'll see if I can pull that up. Okay, let's see. Okay. Okay. I'll get back into it so you can cut off. Let's see.
Okay,
Oh,
perfect.
okay, Gary. Now we're looking at a chart of gold going back 160 years. And yeah, just a couple of things I want to mention here, and I'll try and answer your questions at the same time. So in my book, I talked about the commodity prices look very similar to gold. And so I called this breakout in commodity prices the greatest breakout of all time. But I was thinking yesterday, I needed to edit that and because looking at gold and you had these multiple tests of a 110-year base here. This to me is really the greatest breakout of all time. I know we're going to get into silver, which is coming up on number two, but so that's the significance of this. And just taking a bird's eye view and looking at the rest of the chart, of course, you had this, we went to paper money, and so we had this huge move higher here, and we were able to raise interest rates significantly to kill this move off. And so that forced or created or led to a 20-year secular bear market here. But, gold recovered again, made a new high. Now we had a secular bear here, although this secular bear was so much more mild than this one. And so you could see the cup and handle here. And, we see the breakout in the move. And just if you're thinking about markets and you're thinking about a fiat monetary system, the paper money will always die. It always dies in the end. Like that cannot be disputed. It's just a question of how long is it going to last. And the larger point is we were able to stop this move here by raising interest rates significantly. We can't do that now, so because there's too much debt. Like we would bankrupt the entire system. So again, we're stepping back and we're looking at where is this going to go? You had this move, we were able to raise interest rates, but now we can't raise interest rates. And this cup and handle from like a 50,000 foot historical view, the cup and handle is really just a pause on, to what is coming. So ultimately, and you look at the math I talk about in the book, and there's various things that point to, gold could get to 20 or 30,000 next decade, which to me is easily like that, it's going to happen. And so what this chart tells me is in the next 10 years, I just see this continuing to make a really, really strong move. I mean, there will be something like this in the middle of it. But where is this going? I mean, we can't raise interest rates because there's too much debt in the system. So ultimately, this will end with gold being back in the monetary system.
Yeah, so there's no circuit breaker, so to speak, like there was back in 1980. The circuit breaker being the interest rates. This time around, what's the circuit breaker?
Yeah, the circuit breakers, you have to put gold back into the monetary system.
And but that has to be a pretty exorbitant price because of the amount of M2 money supply, correct?
Correct. And yeah, and again, if you look in the book and you look at you look at in the 30s and 1980, and you look at how much gold we had as the United States, and you look at the price of gold got to a point where our gold covered 100% of the monetary base. Now, to do that today, I think it would have to be $21,000 or $22,000 an ounce, and that's not even counting how much the monetary base might grow in the next 5 or 10 years. So, everything I'm looking at, there's math and history that points to 20, 30,000, maybe even $50,000 an ounce.
It also assumes that all the gold is still there, right? All right. Well, let's move over to the silver chart, which you're saying is the second biggest breakout of all time. It's on deck, so to speak, for the second biggest breakout of all time.
Yeah. Yes, exactly. That's a great way to put it. I might steal that.
Okay.
Or I'll quote you.
Well, hey, I mean, nowadays in baseball, typically the best player is now batting second, and he used to bat third. So, they moved Aaron Judge up to number 2. So here we have silver as Aaron Judge.
So this is quarterly data. So if you use quarterly or monthly or annual data, it looks a little different, but basically $50, everybody knows this is the key resistance. And this looks like a cup and handle, but it's actually not. I don't want to get into that. Gold was a pure cup and handle. This one, this move down here, it corrected way too much. But aside from that, the point is this is in a really big, super bullish base. When this breaks 50, Gary, this is going to really fly. And what stands out to me is this is a chart going back 160 years. Look how prominent this 45-year base is. Now, granted, in 10 years, when we look at this chart and silver is way off the screen, it won't look as prominent. But, nevertheless, I mean, this will be Gold's Cup and Handle will be in textbooks, and this base here will also be in textbooks. And I call it the second greatest breakout of all time because this is a 45-year base. And if we look at I mentioned, gold in 1972, it was breaking out of a 100-year base. Commodity prices then were breaking out of a 100-year base. Silver, we could have put it's not a perfect base, the breakout right here, so I don't include it. But this 45-year base, I don't know of any other major market that is breaking out of a base that's 50 years or longer, or that did or is about to.
Okay.
And so that's why it's number two.
So
Now,
you're basically
interestingly,
saying it's unprecedented.
yes, I mean, yeah, this I mean, it's other than the early 70s, which that was number one. But again, that was kind of artificial.
Yeah.
I
All
mean,
right. So do you have I don't want to say, hey, I don't want to ask you to say, all right, silver's going to hit 500 or 450, but do you have a range expectation where, over the next 5 to 10 years where you think silver could go based on the charts?
yes. Well, let's step back and think about a couple things. So you look at the last 160 years or so and the gold silver ratio, every time there is a major peak in precious metals. I mean, it's around 18, the gold silver is 18x, 15x, 14x, just something like that. So, it will go to that level. It probably won't stay there, but it will go to that level. And so, Gary, I mentioned, gold could go to 20, 30, even 50,000. What does that mean for silver? Like silver is going to $1,000 eventually. Maybe even 2,000. So but and I'm not, again, it's important to understand. I'm not saying that's going to happen tomorrow in 5 years. I'm just saying in the next decade, whether it ends in 10 years or 15 years, I mean, the major peak in precious metals, when gold gets put back into the monetary system, if gold reaches those targets, 20, 30, 50, like let's just say gold goes to 15,000 or 20,000. And you think about again, the peaks or the gold silver ratio at those peaks is around 15x. That's putting silver, even using that $20,000 target, that puts silver over $1,000 an ounce. So
So that
that's
is
where I could,
that's your full expectation based on the math, based on the historical math.
yes,
Your expectation for gold is going up into the teens to 20s, and silver going into the high triple digits to potentially $1,000.
yes. And it's important for people to understand. I'm not talking, this is not something that's going to happen in a few years or 5 or 7 years. This is 10, 12, or 15 years.
It's over the lifespan, yeah.
Now, looking at this target, let's come back a little closer. I talk about this in the book. In 2004, 2005, oil and copper, I think copper broke out of a 30-year base, oil broke out of a 23-year base. They had really strong moves, like 3 years after the breakout or the next 12 or 13 months. I mean, based on what oil and copper did, breaking out of those bases, the moves they made 12 to 15 months after the breakout, you project that forward. Silver, after it breaks 50, could run to 100 like in 12, 15, or 18 months. So, I mean, getting through 35 and 37 right now, that's stiff resistance. I mean,
Yeah.
once silver can break above 35 to 37, it will be that much closer to moving back to 50 and testing that major resistance. But whenever it breaks 50, I mean, you have a measured upside target of about 90 or 95. So that's kind of the near term, potential in the next, 1 year, 2, 3, 4 years, something like that. So there is, $100 an ounce is not that far off.
Okay, so we've seen the charts, for gold versus the market, gold versus the 60/40, gold and its historical projections, silver and its historical projections. What does all of this mean for the miners? Where do you see the miners going? Are the miners are they going to benefit from these moves, or are they going to remain languishing?
Well, I mean, I could talk about the miners in a whole nother interview. Yeah, I think the miners will do really, really well. But the key with miners and juniors is, you have to analyze the company by itself. The problem, and I used to make this in the past, that a lot of people make is they think about, okay, well, silver's going to go to 100, gold's going to go to 5,000. Every gold or silver stock is going to go up. I'm just going to buy something that's at 5 or 10 cents, and I'm going to expect that to go up. That doesn't necessarily work or happen. Like you need to think about, you need to be really precise with your company analysis and stock picking. So that's the reality is that
Now,
in the very
in the 70s, a rising tide raised all boats. Now, some raised tremendous and some raised just a little bit, but a rising tide did raise all boats back in the 70s.
right, and I mean, we will see that again, surely at some point. But if you think about where we are here and now, and you look at, okay, silver's made this move like this, gold has been much stronger in the last year, where it's up 50%. But, you know, a lot of juniors and, even some miners and exploration stock, they haven't moved. They haven't moved that much. So yes, eventually a rising tide will lift all boats. But what I do in my premium service is I'm looking for, okay, what are the best quality companies that have the most upside based on a real bull market? So I'm not trying to get your audience to subscribe to my service, but I'm just pointing out here with respect to miners, I expect the miners to do really, really well, but there are tons of pitfalls. And look, after every huge move of the miners, every huge bull market, they go down 60%. Like
Yeah.
I expect, this we could have a huge boom here in the next 2 or 3 years, 4 years, in gold and silver and all the stocks. But at the end of the decade, we're probably going to have a crash and a 70% move down, which will
Yeah.
set the stage, in my opinion, for, a final move, a final leg higher in the 2030s. And so if
Gotcha.
people, they need to understand that, these huge moves in the miners, and they're not permanent. They can last for a few
Right.
years, but after every huge cyclical bull market, you get a 70% crash correction
Yeah, and
drawdown.
that is exactly what happened in the 70s. They went up in the early 70s. They crashed 70, 80, 90% in the recession in the mid 70s, and then they went bonkers into the late 70s and then crashed again after 1980. So they're not a buy and hold for the next 20, 30 years for sure. All right, so you could take off the chart now, Jordan, and I want to welcome everyone to this fantastic interview with Jordan Roy-Byrne, editor and publisher of the dailygold.com and the Daily Gold Premium. This has been an incredible discussion, the tour through the charts. We really appreciate it. And before we wrap up here, with Jordan, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report that's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content, but even without premium, there's plenty of free content daily. So visit metalsandminers.substack.com. Join us and explore all around. And thank you again for watching this interview. Now, I'm positive that you've enjoyed the conversation with Jordan as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. Now, Jordan, I want to thank you for coming on to Metals and Miners, for being so generous with your time and analysis and ideas. And I want to finish off with your book, Gold and Silver, The Greatest Bull Market Has Begun. It comes at a pivotal time for precious metals and for precious metals investors. I want to know, what key insights or predictions did you aim to share with readers about the unfolding bull market in gold and silver, and where can our audience go get their hands on a copy of this book?
They can get a free copy of the book at thedailygold.com/book. If they opt in there, I will send them a free copy. You can read that on your iPad or whatever device. The book is also on Amazon, although I think there's with the publishing, we're like a little bit at a standstill right now. So if you do want to get a hard copy, it's a little bit more difficult, but just get the free copy. It even looks better reading it on your device. Writing the book, Gary, I did write earlier versions. So this is probably the third version. The first version I wrote in 2015, and I was right about gold and miners making a major, major historical bottom. However, my macro viewpoint was wrong because I was thinking, okay, well, gold is just having a correction. We're going to have a 1976 to 1980 repeat, from 2016 to 2020. And then, that's going to be the end of it. Well, I was completely wrong about that. The second edition, which I wrote, 2019, around that time, I had, my macro viewpoint was really crystallized then. I realized that we are in a secular bear. Precious metals are in a secular bear. The stock market is clearly in a secular bull. But with respect to precious metals, like they had trended up since the end of 2015. So this was much, and a lot of people just assumed, okay, this is a repeat of the 80s and the 90s. Gold will be dead until 2030. But I was looking at everything and realized, this is a lot different. This is a lot like the 1960s. Like this is similar to the early 1960s. And so my macro viewpoint was correct. But this third edition, it really has a lot more. I think this is by far the best edition. I've written about gold against the 60/40 portfolio, how important that is. I've written a lot about miners and juniors, and I've given a history of the market. So it's kind of just all my research, all my best ideas put into a book that's like 150 or 180 pages. So it's not too long. I'm not going to bore you with a lot of stuff in there that doesn't matter. It's really written from an investment standpoint. And some of the major things in the book, the major themes, are things we've touched on this interview. The importance of gold breaking out against the 60/40, breaking out against the stock market. And because and I've been talking about this for the last 2 years, that is why miners and juniors in these stocks and silver are not performing as well, because gold was going up, but it's not outperforming the stock market. It's not outperforming the 60/40. So there wasn't enough capital moving into precious metals because too much capital was still buying stocks. And until that really, you get more capital going into precious metals, then it spills down and over beyond just gold ETFs, and you get into gold stocks, miners, juniors, silver, etc. So that was a huge point I wanted to make in the book. And then there are other important points that, look, a secular bear in the bond market, basically the last one we had was like 1965 to 1982. Gary, from 1920 to 2020, there was only one secular bear in bonds, 65 to 82. So people they don't understand this history that we're clearly repeating that. And you can see the charts in the book that make it obvious. So we're having a bear market in bonds like we had in the mid 60s to the early 80s. And again, the significance of that is that goes into a bear market. Eventually that's going to take the stock market down. And, we may be starting to see that in the last couple of months. And then you have a bond bear market and a stock bear market. These secular trends are down like they were in the mid 60s to the early 80s. I mean, that's what sets up gold and silver. And again, technically, we also mentioned it, technically gold and silver are in a position. I mean, gold's already broken out to a new all-time high. Silver will do that in the next 2, 3, 4 years. And so everything is setting a stage for a repeat of, the mid to late 60s and entire decade of the 1970s. So just all these things. And again, we covered a good amount of them here today in this interview, but I wanted to get all these points just in all my research and analysis into a book, and also all my charts. Like I think there's about 98 charts in the book. So, and these aren't just, they're not just there to fill space. I mean, they're really giving you, really important info in every chart. So yeah, it's basically, all my analysis and, opinions and historical data I've come up with. And I wanted to get that all into a book. And I think the conclusions that I've, in some of my predictions in the book, it's something I was working to over the last, 5, 7 years. So it was a really good time. And the timing turned out to be perfect, actually. Just to put it out just a couple months before, we got gold breaking out against the 60/40, gold breaking out against the stock market. Gary, that's only the fourth time this has happened in the last 100 years. So it's so extremely important what has happened in the last few months.
It's so exciting right now to be in the industry. Now, there's some other things that are not exciting going on in the world of finance, but and the global monetary system. But it's extremely exciting right now in the world of precious metals, and I hope those tuning in are sensing the excitement coming from you because I sure am. All right, so thedailygold.com. How else can folks get in contact with you to not just learn more, but to reach out to you?
They can email me, Jordan at thedailygold.com. They can also subscribe to my Twitter, which is the Daily Gold, and also I have a YouTube where I publish a lot of videos and analysis. So yeah, thedailygold.com.
Okay, wonderful. I'll put all that information up on the screen. I will also have it as click-throughs in the description area so everybody can get through to you. Jordan, I look forward to having you back on sometime soon to talk more exciting things going on in the world of precious metals, gold and silver. Thank you for being here with us, and everybody else, thanks for watching. And I want to welcome everyone to this fantastic interview with Jordan Roy-Byrne, editor and publisher of the dailygold.com and the Daily Gold Premium. This has been an incredible discussion, the tour through the charts. We really appreciate it. And before we wrap up here with Jordan, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report that's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio.